is James Sexton. I specialize in international taxation. I'm the president of esquiregroup. We have offices in Las Vegas, Phoenix, and here in Vienna. We work a lot with Americans with foreign assets, foreign income, Americans that live abroad, how they're taxed, what their filing obligations are. And we also work a lot with foreigners investing into the U.S. So basically, international taxation. One of the things, as many of you probably know, that's different about America is we tax our citizens and residents based on that citizenship. So it doesn't matter where in the world you live as an American or how long you've lived there, you're always liable for tax in the U.S. So you always have to file a tax return, you always have to report your worldwide income, regardless of where you live or how long you've lived there. That's something markedly different from most countries. Most countries tax based on residence. So if you're purely an Austrian citizen, for example, and you move to France, you're going to pay tax in France. You're not going to pay tax in Austria. But as an American or a green card holder, that's not the case. So, who is a U.S. resident? Because the worldwide filing requirements apply to U.S. tax residents. If you're a citizen, you're always considered a tax resident. If you have a green card, you're also always considered a resident. And that's something that a lot of people don't realize. A lot of people think like, oh, it gives me the right to live in the U.S., but once I'm out of the U.S., what does it matter? But for tax purposes, you're basically treated like a citizen. So as long as you have that green card, you need to file in the U.S. And actually giving up that green card is a lot like giving up an American passport. So there's a lot of, there can be an exit tax depending on your net worth and some other factors. The other one is what's called the substantial presence test. And this is one that sometimes people become U.S. tax residents by accident. That could be somebody who's a foreigner that's just spent too much time in the U.S. And that amount of time is 183 days in the last 3 years. And when you calculate the 183 days, like any tax law, there's a complicated formula. So as a U.S. citizen or resident, these are the basic 4 things as far as taxes go that are going to apply to you. The income tax, foreign bank account reporting, the gift tax, and the estate tax. And the gift tax and the estate tax is something that's often forgotten and something that is very important, especially for those Americans that are maybe married to a foreigner that does not have a green card or American passport. Because there's some disfavorable inheritance and gift tax laws. So, if you're an American or U.S. resident living abroad, you basically have the same filing requirements as an American. You have to file a tax return. The only difference is your due date is June 15th instead of April 15th. And you don't have to file anything to get that extension. It's automatic. You have to report your worldwide income. So any interest, dividends, wages, whatever that you've earned anywhere in the world needs to be reported in the United States. Now, there's a couple of special considerations that give some relief so that you don't get double taxed. And that's the foreign earned income exclusion, the foreign housing exclusion or deduction, foreign tax credit, and then there's some additional foreign reporting. So the foreign earned income exclusion is one of the main ways that the U.S. helps Americans living abroad not get taxed doubly. So basically what happens is you can exclude up to $92,900 worth of foreign earned income. 2011, the amount gets adjusted for inflation every year, so for this year it'll be $95,100. This is very important. It must be earned income, which means wages, self-employment income, commissions, tips, things like that are earned, something that you got for working. If it's passive income like interest, dividends, capital gains, that is not excludable. The question of whether or not it is foreign earned income depends on where you did the work. So you could be an American working for an American company being paid by an American company, but performing the work in Austria, that counts as foreign earned income because you did the work here. So it's not a fact, it doesn't matter where it was paid from, it matters where you performed the work. So in order to qualify for the foreign earned income exclusion, you have to meet one of two tests. One of them is the bona fide residence test, and the other one is the physical presence test. So the bona fide residence test is basically you have to have lived in a foreign country and have that as your residence for at least 1 year. This is generally the preferred method if you can qualify for it, because the physical presence test is based off of a number of days, which means you have to have been outside of the US for 330 days in a 12-month period. So that means you can only spend 35 days in a 12-month period in the US. But if you meet the bona fide residence test, then you can spend more time in the US. It's less restrictive in terms of how much time you spend in the United States. In addition to the foreign earned income exclusion, you can take a foreign housing exclusion. And this is to help offset the cost of living expenses like your rent, mortgage interest, insurance, things like that. The maximum you could take in 2011 was $27,870, and so that gets added to the foreign earned income exclusion. So it's really, but this is not per person. There are higher limits for expensive places to live, high-cost locales, which Vienna is one of those. So Vienna, the maximum is $35,400, so about $8,000 more than what the normal maximum is. And again, it has to be, this number is calculated on a percentage of your foreign earned income exclusion. So in order to qualify for the maximum, your income has to be earned. So if you're getting like a lot of dividends or something like that, it's going to be hard to qualify for the foreign housing exclusion. The foreign tax credit is basically the US will give you a credit for tax that you paid abroad. So if you earn income in Austria and you pay tax in Austria, then you're going to get a credit for that tax in the United States. And because Austria's taxes are generally higher than the US's, whatever you paid in Austria normally will cancel out whatever you would have owed in the US, and you wind up not owing anything. This normally will come into play on things like passive income, which can't be excluded under the foreign earned income exclusion. That's when the foreign tax credit becomes really useful because it's going to offset the tax you paid here on those interest and dividends. Likewise, if your earnings go above the foreign earned income exclusion, then the foreign tax credit would come into play on whatever you earned over the foreign earned income and foreign housing exclusion amounts. And then the credits, if you don't use them all up in 1 year, you can carry them back 1 year. You can carry them forward 10 and use them in future years. If you have foreign income and maybe you don't have enough foreign tax credit in that future year to offset everything, you can use what you have from a prior year. The way the foreign tax credit is calculated is there's a limit to it. So you have to take the foreign tax and you multiply it by the foreign taxable income divided by the worldwide taxable income. And then whatever that numerator is, you would apply to the foreign tax that you paid, and that's your foreign tax credit limit. This is another one that comes up frequently. If any of you are self-employed, the foreign tax credit will not wipe out the self-employment tax. So I don't know how many of you are familiar with the U.S. self-employment tax, but if you work for yourself, the U.S. charges an additional tax of 15.3% for being self-employed.